We're live. Hi, David. Welcome to Venture with Grace.
Hello, Grace. It's exciting. I've never done a live stream before.
Okay, amazing. Why don't we start with your background? So, like, since like the last time we chat, I feel like it's super unique that we're both from originally like from China or like Chinese
Mm,
immigrants. Why don't we maybe start with your early on in your career that like you started as a summer associate or like summer analyst at Citibank, and then later on, how did you kind of like get involved with like venture investing?
okay, sounds good. So like you said, I was born in the Bay Area, but I grew up in Beijing, and then I came back to the Bay Area. Actually, even before City, like the very first job that, and this I promise this is related. The very first job I had was on a Korean barbecue taco truck. So I was making like bulgogi burritos and like kalbi burritos.
No way,
Um,
really?
and then that
That's
was
so
in New
fun.
York when I was a student at NYU, and then somehow like started doing like some finance internships. And I'm pretty sure one of the reasons I got the internship was because I mentioned that I worked on this taco truck in my interview. And like the interviewers were like, "Oh, we were looking for this taco truck because like we were going on Twitter, we couldn't find the location." And then like
What?
I made a call and then I was like, "Hey, like this is where the truck is. You can go find it now." Um, Fast forward like a few years, I ended up going into consulting, manager consulting instead at Accenture. I got pretty fortunate in that the main project that I worked on was actually consulting for a large hedge fund to do venture investing. So they were starting to do private markets investing. So they outsourced a lot of their due diligence, like market research sourcing to Accenture. And then from there, moved to DCM because DCM, global venture capital firm, offices in Asia as well as US, and they needed someone with like bilingual and cross-cultural experience. So I've been at DCM for more than 10 years now. I've basically had every single title at the firm. Started as an associate, and then kind of worked my way up. And yeah, it's been an amazing ride since then. And every day I'm like, no, I don't really believe that this is like my actual job. So that's kind of the journey.
Amazing. I feel you. Why don't I mean I definitely am so interested in the taco truck. Sorry, that's got
Mm,
super sidetracked. But anyway, so I wonder, maybe before we start like diving into the portfolio companies or like investing trends, why don't you maybe like give us like a brief background of DCM? Like what are you guys
mm.
investing in? And obviously you guys have like a lot of like really big logos on your profile. We could dive in like SoFi or Bill.com or something like that later. So let's start with the brief background of DCM.
Yeah. DCM has been around for almost 30 years. We were one of the first American VCs to open up offices in Asia. And then so today we invest basically across the Pacific between US, Korea, Japan, China. Um, we manage about 4 billion of assets. We do seed all the way up to sometimes even Series B, but I would say our sweet spot is seed and Series A. We generally lead those rounds. And then in terms of sector focus, we're pretty sector agnostic and everyone kind of looks at everything. So I would say like software, marketplaces, fintech, consumer social, honestly, even some like enterprise stuff, hardware. We kind of had like kind of wins and experiences across all of those verticals. I would say the one thing that kind of sets us apart, aside from being global, is that for early stage investors, we take a very concentrated and high touch approach, and that we don't. Each partner probably only makes four at most investments per year, and the idea is that there there are actually very few things we think early stage venture capitalists can do for a portfolio company, but there are only like a handful of things. And to do those things really well, you cannot make too many new investments per year. Otherwise, you don't have the context to actually do those few things very well because you're constantly jumping and context switching between different portfolio companies and boards. So that way, um, for us, like even though we're early stage investors, we don't spray and pray. We don't make too many new relationships per year, and we try to make it very concentrated and say like, okay, we're only going to do a few very high conviction bets per year.
I feel like from like a seed stage, if you're doing like concentrated bets, it's like actually semi controversial just because I feel like
Mm-hmm.
it's hard. From like the sourcing perspective, obviously I know that like a lot some of the like big names that like on the profile, let's say call it like a Musically or something,
Mm-hmm.
like it is by like, started by like Chinese entrepreneurs in the US, like that maybe gave you an edge since like DCMs are quite big in like Asia, and like I wonder when it comes to like when you're thinking about like sourcing the right founders, maybe we could use your portfolio like, you know, Brigit or like EvenUp or SoFi. Like, you know, what are some sourcing channel that you're using that's like uniquely positioning you to like making high concentrated bets?
Yeah, so Musically was actually really interesting because Musically, as you mentioned, was based in Shanghai when we invested. So that was kind of like a cross-border effort that I actually worked on with my colleague Sarah. So originally we found it in China, but then we realized that most of the customers or users were based in the US. So we then had a pretty, I think, unique advantage in diligence in the company, and that we could obviously diligence the management team and the product team in Shanghai, but also do our market research by leveraging our US team. So that was quite unique and interesting to us. In terms of, I guess, other ones, so I think the cool thing about early stage venture investing is that there's so many different ways to do it, and there's so many different like how one person's sources can be very different from how another person's sources, and as long as you find something that's genuine to you, then I think that works. So so I think a lot of ways like people source for early stage is just by crawling a lot of different websites and whatnot. But specifically, I'll talk about like EvenUp and Brigit's example, and then I'll kind of talk about like my general framework for sourcing. So Brigit actually there was this like big kind of, I guess, trend for a lot of cross-border VCs back in 2015, 16, which was, so if you think about a lot of Chinese venture investments as copy to China, there was a kind of a trend around like copy from China. So like let's look at what are some big consumer fintech outcomes in China, or consumer outcomes that we can bring to the US. So there was a concept in China around like Mai Jinfu, or like Ant Financial,
Oh yeah.
around using like alternative data to underwrite customers and provide fintech solutions, etc. So this is kind of like one way of sourcing, which is you kind of put out like a call for startups, or you put out content, or you put out things like, hey, I'm looking for this kind of startup. Either you write it, you go on a podcast like this, or you tell your network like, this is what I'm looking for. If you find something like this, please send it to me. So I had started building this thesis around like, well, if in China they're using alternative data to underwrite customers that otherwise would not have access to credit, like in the US, we have something comparable, which is anybody with a FICO score below 650 or maybe 600. Like if you have a FICO score below 600 back in 2015, it was very hard for you to access credit. So what are different ways that you could like underwrite folks? So I just kind of started talking about this thesis, and interestingly enough, actually, one of my friends who is based in China knew Brigit, which was a US company. They were just friends and sent that to us. And then so this came through the network, but because we had put out this like call for like, this is what I'm looking for. And then that gives you obviously a prepared mind to then evaluate an opportunity that like Brigit today is hundreds of millions of revenue, which is like public knowledge. It's a very large company. It's doing very well. Back then it was 3 people. There was no product. So like, what were you evaluating then other than the product vision? And if you get lucky and the product vision aligns with the thesis that you're building, then you have a very like interesting kind of like situation where you can move very quickly, you have a prepared mind, and you're able to like source a lot of opportunities because people know that you're looking for that. Sorry.
Yeah, sorry. Keep going. Sorry.
No, go for it. Go for it.
Oh, I wonder, so like I think that's really interesting, but like why do you feel like that company would succeed in the US? Just because like there's so many people are copying like, you know, the live stream shopping or everything else. I feel like China is like in a really unique position. It's like, you know, a lot of people in the past like may not really have like I think people just like skip the credit card era. So like, you know, like the digital finance is very robust in a way, just because like a lot of people just jump into the mobile finance era, skip the credit card in general whatsoever. But like I feel like in the US is like the climate of like the financial climate is like very different. Like you mentioned, like, you know, the credit score is like the ecosystem is already very built up. What's your thought process on like evaluating if a certain idea that would actually pull off in the US or like the Western culture in general?
I think it actually has to. I think this is like a unique to us maybe point of view because we
Yeah.
like I've operated across Japan, U.S., Korea, China for so long, and each
Right.
one of our teams is like a very local team. But I think for these companies to succeed, like we call it like copy from, copy to, almost kind of like um, almost kind of like facetiously. Like in order for it to succeed, it actually has to have nothing to do with the local the prior inspiration, other
Mhm.
than like the original spark of the idea. Because I think the reason a lot of these like copy to, copy from companies don't succeed is because they actually just carbon copy whatever happened in like another country and try to bring it over without localizing anything at all or understanding like the local kind of constraints. So like in the case of I think Ant Financial and like every like Credit Ease, all these other ones, they're basically charging like super high interest and using like tons of random alternative data that like an
Mhm.
American consumer would never ever give for you to be able to give credit. Whereas here, like the company itself, like they weren't thinking like, hey, we're gonna copy Ant Financial. They barely even knew Ant Financial, but it was I guess the investor that was like there's a framework for building this type of company, and we're gonna apply it for a similar opportunity in the U.S. where we think it's underserved, and we can potentially use this to like spot opportunities that are a little bit overlooked or underserved. So in the case of Brigit and a lot of the companies serving, I guess what you call like the underserved during that period of time, and there are lots of others like Dave, Moneyline, Chime. These are all like really large companies now, and they were all kind of started around that time. Some even earlier than Brigit, and I think coming out of the success of SoFi, which was another one of our investments, there was this like thought that you should focus all your efforts on serving people with good credit scores and good incomes. And you
Mhm.
should avoid people that are like underserved because there's no way you can underwrite them and give them loans profitably. So
Mhm.
like, but of course we had a different point of view because we saw in Asia, we were like, okay, well, there are people that you couldn't serve because there's no credit score. So like clearly there's a way to do it. And then so like I think the key of this like copy to, copy from is more about changing your frame of mind of like what is a good sector and what is not a good sector, as opposed to carbon copying a business model over. Where because if you do that, you're pretty much going to fail because like every country is just so different.
For sure. I wonder when it comes to like, maybe we could maybe we could talk about like, the AI's application into different companies. Since
Hmm.
I know that you guys invest in a lot of like consumer companies like a Musically or um like SoFi. I would all
Yeah.
consider them as like consumer companies. I wonder, how do you think AI is like kind of applying into the consumer tech companies in general?
So I mean, there's two ways that we're kind of like thinking about it. There's like trying to get as many of our existing companies. So I think the funny thing about like AI is like all these companies were using some form of AI like even like
Mhm.
10 years ago, right? Like we have an
Right.
investment in a company called Matterport, which we've since like it's like a real estate computer vision company. Like we did
Mhm.
this investment in like 2008. They're using computer vision, and then also Musically was probably one of the like Musically and also like Kuaishou and a few others were all using
Mhm.
like AI to like serve up different types of content and like make their ads more responsive.
Mhm.
Um, so there's like making the company more like operationally more efficient and like reducing the need for like humans to do like safety and like checking sure there's no like bad content. And then there's obviously like new like AI experiences. Um, so like I think there we're still quite in the early innings because frankly like a lot of the newer like AI experiences still I think I don't know. Chris Dixon had like a really good quote about crypto like years ago, which is like all new things look like toys. And we're definitely still in that toy phase, and these toys aren't super sticky yet. So everyone's looking for what's a better way to like grow really fast in terms of offering a new like AI consumer experience, but then also retain these users because you create a bunch of pictures or you create a bunch of like fun text or even like funny videos for your friends. You
Mhm.
send it around. You change your profile picture a little bit. It's like a new like AI generated profile picture,
Mhm.
and then like I don't know, like a week later, you're kind of bored of it, and there's like not much more engagement left. Um, and so like, what do you do from there? So I think frankly, like right now, where we're more active in terms of investing is like applied AI for like B2B or types of like vertical AI. So there we've been like quite active. Whereas on the consumer side, it's still a lot of like waiting and seeing to see like what actually sticks, and then when things stick, then just move quickly.
Yeah, so I want to maybe double click on that, and then we can jump into vertical AI. Which is like, I feel like as a angel investor, like I see like crazy like amount of companies that are doing a lot of things in different sectors, especially in the consumer space. Let's say like an AI toy company, like basically like a toy that like your kid can play to like learn about stuff. Like I don't really know like how much AI is like actually implemented.
I think I saw that company recently. I think we might be talking about the same company.
I would not be surprised. There's a lot of
Yeah.
them too. So like also like there would be, let's say, call it like leveraging AI to make your website. Let's say like you draw a website on a piece of paper, and then like this this company would turn it into like an actual website using it. Like there's so many things out there. How do you filter out like what is like the 10 ideas that you would never invest in? Just because I feel like a lot of times, like when I see the founder, I hear them talk. I'm like, wow, this sounds like a really smart person doing a really smart project. But the problem is like, any fund, it doesn't have like an unlimited amount of capital. You can only make a certain amount of bets. Like, how would you what's your thinking framework on eliminating like the certain deals that like you would never invest?
I don't really have this, if I'm being honest. I think like I don't think that's like the right way to do it. I think, like I said, like everyone has their way of doing it. And everyone should find like their strength and like their weakness and whatever. So I think frankly, like for me, like early stage investing at seed and Series A is a lot of it is like revisiting your priors, or not letting like past failures, either of yours or of someone else's that you've studied, necessarily influence like what you do or don't do. So like, for example, um, like like education, or like ed tech, or like children's learning, like usually like people probably say like, oh, it's like not that interesting of a space. Like, as you probably mentioned it because a lot of people have said it's like not that interesting of a space. It's a weird, like, who's gonna pay for it? Like the payer is like the parent, but then the consumer is actually the kid. It's like this weird disconnected incentive problem. Like there's just like a super crowded. There's no like likely acquirer. Like and then some people just kind of avoid it. But like the whole point of startups is like counter positioning, and the whole point of startups is like, if you think of like Michael Christensen, it's like the high end disruptors, low end disruptors. The only way a startup wins is by coming into like the low end and like disrupting like an incumbent. So like if you have like whole verticals that you're just like, I'm not going to do this because I think it's a bad vertical, like I think you're going to miss out on like a lot of different things, and potentially like the whole point of a startup is to like redefine a vertical. Now, then the question is like, how do you avoid like boiling the ocean? Because then you look at everything. Um, I don't think there's any way to avoid that, honestly. I think you just have to look at like a lot of stuff, and then sometimes you like prioritize of like, I think this is more interesting than this right now, and it's kind of just like constantly moving like forced rank order of like what's more interesting. But I would never personally feel comfortable just saying no to an entire space. So I think then you have to look at certain signals around like, um, is the approach like interesting enough to change your mind or your biases about a space? Is the team good enough? Like I think you alluded to that, where like if this team is like clearly smarter than me, and if they're looking into this, then there must be something here. So let me go investigate. And like it's like a 50% chance there's actually nothing there, and they're kind of just like, you have a difference of opinion, or it's like there's like some interesting enough like early signals of traction. Of course, at seed and Series A, like the signals are limited, but like sometimes things can happen in a way where you're like, okay, something interesting is happening here that's changed from 5 years ago, and maybe there's like the perennial question that a lot of VCs ask is like, okay, why now versus why why was 10 years ago too early, and or like why is now like the perfect time? So I think I don't really think about like, I definitely don't do this because it's a bad vertical. And a lot of like my best investments have been in verticals where like maybe 5 years prior, you asked me, I'd be like, probably not going to do anything in like legal tech, or probably not going to do anything in like subprime lending, you know? So
I feel you. So why don't we talk about like the vertical ad sector? So you
Mhm.
mentioned EvenUp. So there's like so many legal AI companies that's like popping out lately. Tell us more about like maybe like how do you find the company, and then what's your kind of like evaluation process on EvenUp?
Yeah, so Tom Seo, actually from Dash Fund, was one of the earlier angel investors. He actually sent this to me, and so then like I said, so like this is more of just like through the network. So he sent it, and then evaluate. And so basically, I had kind of like tangent. Again, this is more about like maybe the key is like having a prepared mind, and like feeling like it's like there are a few sectors that I'm interested in because of like an overall thesis. So we had looked at a bunch of legal tech in the past, and we thought like, okay, it's weird. There's a weird incentive problem here that maybe like now like AI is going to solve it, because like the rising tide of AI is just like so strong, which is like you have a bunch of lawyers that bill hourly, they bill their customers. Why would those lawyers want to be more efficient? Like it's going to reduce it's not like because they have AI they can bill more per hour. It's going to reduce the number of, so like there's going to be a transformation that like legal is going to go through. So when it's come to like traditional SaaS, that like kept us like on the sidelines for a little bit. Plus there was just like a lot of like competition, and law firms were like slow to adopt technology. So when EvenUp came around, we were like, okay, this incentive problem is solved. And we understood like the power of like building like a data network effect and building data moats, because a lot of the fintech companies that we had invested in prior, like SoFi, Brigit, like even Bill.com had like a bit of like a network effect with like the different channels that they had. Once you build a network effect, you have a very strong business. And typically, a lot of SaaS businesses back then, at least, didn't necessarily have that. It was just like build a good SaaS sales team and go to market. So what does EvenUp do? So EvenUp sells like AI software for personal injury attorneys. The way personal injury attorneys work is that they, let's say you get hit by a car, you look around for a billboard, you call them, you like 1-800, I got hurt or something. They take you on as a client. They only get paid when you get paid. So they take 20 to 30% of your settlement value that you get paid from the counterparty insurance company of the person that hit you with their car. So in that way, the incentives are like beautifully aligned in that like they want to buy software that increases their settlement value, but also reduces the time it takes for them to get to that settlement. So EvenUp basically automates the core part of their job, which is drafting what's called a demand letter. And in that demand letter, there's a bunch of like math and argument and formulas around like why someone deserves to be paid a certain amount for the injury that they have. So there's like insurance data, medical data, like legal data that all goes in there. So it didn't have the problem that a lot of prior legal solutions had, especially when we were looking at it. So I think we made this investment in 2020. So this is we led the seed round in July of 2020, I believe. So that was like way before anyone was talking about AI. We weren't necessarily thinking about like what are all the AI solutions. We were just like, this makes a lot of sense because we have a prepared mind, and also we knew that this was important also for consumers eventually, because through our fintech investing, we knew that like this money that the consumers are going to get paid is very valuable, because most Americans have less than $700 in their bank account. If they don't work for 6 months, they're in a very tough situation. It was COVID, so people were even like, this is before all the stimulus checks, so like people were in a tougher place. So just like a lot of value propositions aligned quite well. And so we made the investment, and then also we knew that like if they continued building up their customer set, they would build a very large corpus of data of personal injury settlements, and then that would make it pretty like, I guess, hard to overcome for new competitors that wanted to do similar software, because they would have the most accurate settlement information, the most accurate like insurance result information. And then so it was like kind of like a data network effect, which I don't think back then was talked about too much, but now like of course every AI company, what they argue is like, yeah, this is like beautiful loop that we have, and we build this like network effect. But I mean, it depends, right? Like it depends if are you saying you're going to have a better data capture loop than some of the existing LLMs? Are you going to go after a space? And this is like why I mentioned like personal injury law, like law was like not on anyone's like mind back in 2020. Everyone was so jaded about the space. And I think that's where the opportunity is for both startups and for early stage investors to find things that are a little bit like, I don't know, under the radar, I guess.
For sure. How do you think about like the personal injury as a starting point, or like
Mm,
when the founder pitched you, like did you ask them like, I guess like since like there's so many, I would imagine like a lot of the lawyer spending are like on the business end, like, because of like big corporation have money, and then like if you're getting sued or not, like,
mhm,
or if you're suing someone else, it's like typically the spending will be like a lot bigger than personal injury. That's what I would assume. Like, how do you think about like the subsector that they picked? And let's say if today like a AI legal company come to pitch you, and then they have like
mhm,
call it like $1 million ARR,
mhm.
how do you kind of evaluate that company against their peers?
So I guess like going back to personal injury. So
Yeah.
I'm gonna admit, prior to, we had this like framework for like what makes sense and what doesn't make sense, and like
Mhm.
law, and also like around like what are the pain points of the American consumer. We
Yeah.
knew nothing about personal injury law like prior to meeting this company, right? So and then I think this happens in like early stage like seed investing a lot. Like you probably know nothing about the sector like prior to investing in the company, and then you just have to like ramp up really quickly. Um, so what we quickly discovered though was that like actually most, like not most, like maybe 40% of attorneys in the US are actually personal injury attorneys. So in terms of like total group, yeah, exactly. Like it's actually, I mean, you'll start noticing the billboards now after this
Mhm.
conversation. You'll start realizing like
Yeah.
there's like their advertising is like everywhere. Like
Yeah. Yeah.
TV, billboards, like buses,
Mhm.
like newspapers, like they're everywhere. So in terms of like total size, we were like in terms of headcount, it's one of the biggest sectors within legal. I think it's actually bigger than like pure corporate attorneys, because corporate attorneys charge a lot, and there are like a lot. We interact with a lot of those law firms, but in terms of headcount, I think there are other sectors that like are big, and I think like there are others like immigration law, employment law that are also like similarly big in terms of like sector, because I mean most Americans don't interact with corporate attorneys on like a daily basis, right? Like you and
Mhm.
I interact with Gunderson and Wilson Sonsini like probably like weekly, but like I don't know, like I think like my mom. That's not true. My mom's a lawyer, so she probably knows. But like most people's parents don't know like don't know like Gunderson, right? Whereas but they probably do know like Morgan and Morgan, because they see Morgan and Morgan's advertisements everywhere. They probably have a friend who was hit by a car and they know a personal injury attorney. So um, and then the second piece was like, so that was very easy. Like we like a quick search, you realize like this is like a huge space. Actually, it might be one of the biggest spaces within legal.
Mhm.
Um, and then you have also the counterparty insurance side, who like they hire attorneys too to help
Mhm.
defend themselves. And then when you start doing your diligence, so back then actually, like today, like we would just do a bunch of like expert network calls and whatever. Um, Back then there was actually not that much like on expert networks on personal injury attorneys, because again, nobody in tech cared about this space. So like our diligence process was actually pretty funny. So like we we just went on Yelp and we called like 10 personal injury attorneys, and we pretended to be in an accident, or rather like I pretended to be in an accident. And then like I went through the process a little bit with them as far as I could go without like providing actual like medical information. And then from there, we built enough relationship to realize like to understand the P&Ls of the personal injury firms, understand
Mhm.
like how much money they're actually making, how profitable they are, sometimes how little work they actually do. And then kind of like one funny anecdote that we like then discovered was actually like, I'm pretty sure he's the richest attorney in the U.S. He's a personal injury attorney. His name is John Morgan. Um, he had then had aspirations to run for president. I don't think so anymore, but like that was kind of like, I think we got quite lucky and excited like as soon as we finished our diligence, realizing that like this is actually a huge space, and like it's actually an amazing space, because these personal injury firms are actually quite good businesses. They want to be even better businesses. It's a no-brainer for them to adopt the solution, and it's huge, but nobody's paying attention to it. I don't think that's always going to be the case, but I think we aspire to find those industries as opposed to going after more like red ocean markets that everyone knows is a good space. There's going to be 20 companies that all do the same thing, and you just have to make sure you pick the right one, make sure that that right one raises like the most capital, and like go after it. So you asked me like if a legal company comes to me with $1 million of ARR, like how do I evaluate it? I think the first thing that I start with, well, if it has $1 million of ARR, there's kind of like a qualitative piece and a quantitative piece. So I'll start with the qualitative piece. The first thing that we look at is like, okay, what's different about this company? What's the differentiation? So it really could be as simple as like, this team is, and I think a lot of times the answer is like, this team is just better than any other team. Like you evaluate all the teams, and this team is just better. They have more experience. They're just smarter. Like, and I think a lot of times investors will tell you like, I back this team versus this team because I just think this team is smarter. Like, which is kind of, I think it's like not, you just don't say it, but it's the truth. I mean, it's similar to why like startups pick certain investors over other investors. They might be like, oh, David's an idiot. Like, I'm gonna go with Demi instead because Demi's, way better. Like, and then the third piece is like the team has like a unique angle in terms of like their go-to-market strategy that they have, or they have access to a certain channel that nobody else has. The other points of differentiation are like what potentially your wedge into a space is different than someone else's wedge, and that wedge gives you a better like unassailable moat to be able to like do something or like expand surface area within a company and a product, whereas someone else's wedge may not be as good. And then the third piece is just like the product, and then product diligence. I think a lot of times you talk to customers or you have your own unique insight into like why a certain product is better versus the other. So I think there's like plenty of spaces where like we'll back a company that is already like, I guess you can call it like one of N. So there's like many different types. We just believe that their approach is better, and then they can win. So I mean, like SoFi very much was like the case, right? Like SoFi was kind of competing against Lending Club, Cabbage, a few other ones, but like we just thought their approach of underwriting, like initially like college grads, good jobs, making it easier for them to get loans versus doing a more broader approach, which is better. And then eventually they use that to outflank the competition and become a general services company. On the quantitative side, let's say it's at $1 million of ARR, at that point, you're probably not looking at like traditional SaaS metrics like net dollar retention, gross dollar retention, magic number, etc. However, like what you are looking at is like you can still do like quantitative analysis. So one thing that we look at that point, depending on the contract size, is your like each month or each cohort or however you want to break it down, is your ACV slowly going up while your like kind of like rough approximation of CAC or go-to-market velocity is more in your favor. So like at that point, it's hard to calculate CAC because it's probably like founder-led sales, but like there are ways you can approximate CAC, or you can look at like changes in go-to-market velocity. So as ACVs are increasing and go-to-market velocity is either also increasing or CAC is going down, you can see it like getting like, I guess like more and more like product market fit. So that's like one way to measure it quantitatively. The second piece is like then like almost like talking to the customers that make up that 1 million of ARR and kind of understanding their proclivity to start expanding ACVs, or like what the procurement process was like and how like readily acceptable and easy it was. And I think the third point, which is still usually it's like qualitative but can still be quantitative, is by understanding the like budget that the million of ARR is coming from the customer side, and trying to map that to an ROI for the customer. So like that is more of like a little bit of a judgment call and like qualitative, and like a lot of times you're not going to have an ROI because we talk to customers sometimes for like other software companies we invest in, and they're like, yeah, we didn't really think about it in terms of ROI. We just really like the software, but like we as investors can match it to an ROI, or we can try to. So in the case of EvenUp, like they had no customers when we invested, like barely had a product, but we had talked to like 10 personal injury attorneys already, and a lot of those personal injury attorneys probably thought I was their customer or soon to be their customer. But we could match it to an ROI based on like what we thought the ACVs would be, because we were like, okay, they employ this many legal assistants and paralegals. It takes them this long to write a demand letter. Their average demand letter settlement amount is about 100K. They take 20% of that, so that's 20K to them. So we basically can build like a sensitivity table around like, if they can increase the settlement amount by this much, decrease the time it takes to do it, like their ROI on buying this software that's like I don't know, like 5 figures or 6 figures is like approximately like this much. Like this makes a lot of sense. So it should be like all else equal, this will be a no-brainer for them to adopt the software because it's solving this like pretty critical business problem that drops straight to their bottom line. And that comes with like understanding the P&L and like pockets of spend or pockets of like frustration for a lot of these like B2B buyers. So it's like, it's quantitative, but like you can make it, qualitative, but you can kind of make it quantitative.
Totally. I have a question on the client acquisition part. So, like, let's
Right.
say if the person would say, hey, they were an attorney and then they, knew a bunch of people in the industry, or like, let's say they have, they're like a legal as legal like association
Mhm.
hat or something like. So basically the TL there is like, what if they knew a bunch of people in the legal industry, so they can like instantly deploy their um AI product into a bunch of lawyers' hands. But on the other hand, it's like, how are they actually doing out like currently it's like, let's say it's all from their network,
Mhm.
but you don't really know you can't predict if the person can like keep building up their network in the industry, or like, if the sales are gonna keep growing like a rocket ship. And also, how do you think about, like, since you mentioned about like doing these diligence on like, calling the random attorneys on
Mhm.
a Yelp page, but for to selling to corporate, it's like a little bit harder to just be like calling, "Hey Google, will you use blah blah blah's product?" So what's the thought process on like doing diligence when the people are selling to like since it's vertical AI, to selling to like
Yeah.
corporate vertical um kind of thing?
I think it's more or less similar, right? So the reason by the way, like we went on Yelp and had to like find our own attorneys is
Mhm.
because a lot of the existing expert networks, so like Tigis or like AlphaSense, like they didn't have personal injury attorneys back then on the
Mhm.
networks. But now like everyone kind of understands like personal injury is like an interesting space, so you can just go on these expert networks and just like pay to talk to personal injury attorneys. Whereas if you're selling to like a Google or like corporates like LinkedIn or whatever, like it's those are much more actually easily accessible experts or buyers to talk to because
Mhm.
we all have them in our network. Maybe our other companies like sell to them, and then you can go on these like paid expert networks and just like find somebody to on Google or like these big companies for you to talk to. So that's actually probably an easier diligence process, and they have like on the customer side, and they have like very like well built out procurement processes, and like they can evaluate these things. I think like so that's the easier side. I think the harder thing about selling to or investing in companies that sell to these bigger companies is actually like there are many startups that all want to sell like X to Google. There are many
Mhm.
startups that all want to sell like X to like I don't know like LinkedIn or like Microsoft because like
Mhm.
those are multi-million dollar contracts. And then so the
Mhm.
harder thing as an investor isn't then assessing like the hard thing about investing in vertical software and vertical AI is to me it's assessing market size like because that'll make or break the investment. Because there's going to be not as many companies going after a particular space. So picking the right one is not it's still everything's hard. Everything is hard.
Mhm.
But like it's like on a relative basis. I don't want to make it sound easy. On a relative basis, like that's not the hard part. The hard part is making sure the space is big enough because if the space is not big enough, like you're done. It's like it's not going to be a big enough outcome. The market isn't deep enough. Like eventually it's going to saturate. Like growth is going to slow down because you just run out of customers, or you have to pivot into an adjacent vertical, and that's always really hard. The hard part about selling like backing companies that sell to like Google and like Microsoft is like picking the right one because if you're selling to Google, chances are you're going after a big enough space. Like I don't think anyone like would question like Databricks or like Snowflake's market size. Maybe back then they did, but like today they would definitely not. The hard part is like picking like the right one because like there's going to be like everyone knows it's a big space, so it's like a red ocean. So you have to back the right team, and then you also have to win that investment, which is also like
Mhm.
a very hard part about for venture investors going after like a red ocean because there are many great venture firms and everyone's very likable. Everyone has great value add services. Everyone has great experiences. Everyone takes entrepreneurs out to the same Warriors games, the same dinners, and then so that's kind of like the hard part about like doing that kind of investing.
For sure. I wonder when it comes to um I mean, this question just like pop up on my head. Like the other day I was training with a founder. Like so their question was like, should I raise like a seed or series A? Like, for example, I feel like it always come down to maybe ARR. I don't really know why the question exists. Maybe because of like a lot of people raise like a pre-seed, but it's like big enough, or like their revenue positive or something. There's some sort of indicator that they are like kind of reaching to the next milestone, and then they want higher valuation. Maybe that's like why. But like I wonder, let's say like I guess like what's a matrix benchmark for call it like a Series A these days? Is I like call it like 3 to 5 million ARR? Like what's a kind of vibe here?
The vibe, it depends on what kind of company.
Sorry,
It
like
depends on it
in
depends
the
on what your vibe.
vertical AI SaaS space, I guess.
I I've been getting this question for 10 years, and
Mhm.
I still don't have a good answer for this question. I think like the lazy answer would be like, oh yeah, like 1 to 2 million of ARR, you raise a Series A, right? But like based off of what? Like I don't, so I think I don't think there is a right answer, honestly. I think it all depends on, actually a lot of it is like storytelling, because I'm sure you've seen and I've seen and a lot of other
Mhm.
people have seen like Series A, like I'm doing 3 to 5 million of ARR. Here's a 10 million Series A on like a 40 to 50 million valuation, and that's like awesome. But we've also seen like Series A's where it's like I got nothing. I have like one pilot customer. I'm burning like $1 million a month because I have all these like machine learning engineers, and like I have to get a sick office, and I'm raising like a $30 million Series A, and this is gonna get me to like a few million of AR, and like people end up doing it because like they think the team is good enough, um, the market is interesting enough, the approach is interesting, and there's like usually like a pretty decent pipeline. So like
Mhm.
you asked like what is the vibe, right? Like that's the answer. It's like it depends on the vibe of the company.
I'm sorry. I
So
like I'm lack of a
but
better words here, but
yeah. But for me, I mean, obviously, like I would just say no. Well, I shouldn't say never, right? Because I don't want to shoot myself in the foot if I ever do like see one of these opportunities where I'm just like, oh, the vibe is awesome. I got to do this deal. But I probably will not do that kind of Series A, because like realistically, like the way I think about it is the way I think about it is like the Series A is should be you should work backwards from like an
Mhm.
eventual like exit, or not even exit, but like at what point is like the company self-sustaining and can like kind of create its own value without like taking more dilution. So like it can be
Mhm.
profitable, it can be when it exits or whatever. And then so like
Mhm.
working backwards from that, you like then think about like how many more rounds of dilution you need and how many more rounds of financing. So like if you have nothing today, you raise a, let's say like a $50 million Series A, you take like 20-25% dilution that like assumes like a valuation or like already in like the 200-250 million range. And it's like, okay, cool. Like how far is this 50 million going to get you to like be able to justify, let's say, a 2x markup, so 500 million the next round? Like if it doesn't make sense and like we can't bridge that gap, and the next round you're like the vibe is still going to be good, someone's going to mark me up, like I have a very hard time like taking a bet on that versus saying like here's like $8 to $10 million. This $8 to $10 million over the course of 2 years is going to get our ARR from 2 million to, let's say, like base case 6 million, like bull case like 10 million. From 10 million, let's say like we like I don't know, like current like SaaS multiples hold, or like we have some like SaaS expansion margin, like or multiple expansion. Then from here, then we can definitely justify $100 million valuation because like it'll be like 10x of 10 million. Then I'm like, okay, that makes sense because you'll need to raise another round of capital. I don't think that's always the framework, because if you stick to like rigid to that, you're gonna miss out on things that like break the rule, and things break the rule all the time in early stage venture. But I'm saying like I'm describing like that's like my perfect scenario for like a Series A, or that's like my perfect scenario for like a seed, because we're always working backwards from like the like next rounds of financing. So I wouldn't say like what is the metric, but it's more about like we're gonna basically work together. So like tell me a story or tell me the narrative and like all the reasons for why you think we can get to the next rounds of financing. Um, but and also at DCM we're multi-stage investors, so like obviously we're also thinking about like what do we need to believe for us to want to do the Series A in a very big meaningful way if we've done the seed round as well.
I'm writing this down because I feel like those are some great insights. I wonder, how do you think about the progress that they have to make to raise like the next round for like a Series A or something, and then like how do you think about like each deal? Do you think about like each deal as like a completely new deal, or like do you think about it as, so for example, if you invest their seed and then you're thinking about investing in Series A, like do you think about it as like a new deal completely, or do you feel like it's still like should be like, you know, you just like have like a favor to invest in them because like in the past you have invested in them, you will have like more
No,
like that?
that's not a good, that's a good way to lose money. Yeah, I think we're not the best at this. I think we also fall into this trap. I think like um, as an insider, you should have more like asymmetric information because yeah, I think you have to earn the. It should be viewed as a new investment because you are deploying capital again. So every as like as like a money manager, which is like, you know, what we are at the end of the day. Like we have a duty to our LPs to make sure that they have like a good return. Just like we have a duty to entrepreneurs to make sure that they have a good experience. And I think like venture is all about like balancing the two while trying to like make money. We should treat it like a new investment. Just because you are an existing doesn't mean that like you take a less like stringent diligence process. It doesn't mean that you just kind of like follow on like without doing any kind of diligence. That said, like because you've worked with the company, and I think you need to earn this right, which is why like the worst combination is like a passive investor who just like automatically like just doubles down on like the next round without doing any diligence because you haven't earned the right to like invest in the company again by working with the company and building that asymmetric information over the course of working with them, and you didn't re-underwrite it like it's a new investment because again like when you made the investment you had an original investment thesis, or like I hope so, around like the market, the approach, the what you thought the team was going to be, and also like how you thought competition was going to evolve. When you make the investment again, you should probably look at the memo that you wrote and like verify. So one thing that we always write in our memos is like, what do we need to believe at the Series A for our thesis to still hold true? So like a lot of firms have something like this. They call it like pre-parade, pre-mortem, or like Bessemer has like scenario analysis and all the different base cases, like and like bear cases and bull cases. And then so I think you should really like be really stringent on that and evaluate that, and then treat it like a new investment. But it should be quite easy because like again, if you earn the right to work with these companies and you spend a lot of time with them, those things should like naturally, you should honestly be like naturally like evaluating the company as you work with them over time.
I always feel like the bear cases or like the bull cases are kind of like made up. Like, I'm sorry, but like I feel like a lot of times
Yeah,
it's just like hard
they
to be
are.
like, okay,
They
should I
are.
just be like, I think the base cases like or like the bear cases should always be 0 because of like it's um you know, they could like I don't know, like anyone could like I feel like after COVID, I feel like everything it's like so unpredictable. Not after COVID, but like, you know, since COVID happened, like, you know, like a lot of people would be doing like in person. I heard like an in-person event company overnight changed to like a full-on Zoom company. So like I feel like a lot of the predictable revenue probably all are gone kind of thing. So like I think it's really hard to um do the predictions to a degree in like an earlier stage company. But anyway, so from the like valuation perspective, I understand like a lot of founders want to raise as much money as possible with less amount of dilution, but on the other hand, like that may not be playing favor for their next round and stuff like that.
Mhm.
So I've heard from founders that they're like comparing themselves with like the industry leader. Let's say, hey, we're better than X product. Even X product is invested by call it tier one investor A and like, you know, famous person B or something. So like um but like their product sucks, they're losing money, like, you know, we're actually making money, so we should be like valued on par of like whatever they're doing. Um what's your thought process on valuation, since like some of the AI companies their valuation are
Mhm.
like so high at a C
Mhm.
stage?
It's hard. So as you said, we don't know. Like we don't know anything. Nobody knows anything. But so we actually start a lot of our IC conversations. This is just us. It's like we don't know. we don't know about this. We don't know about this. However, we still have to do our best to make an educated guess or try to find an answer and try to say, this is what we think will happen with the market. This is what we think will happen with customer adoption of the product based on the team's track record and experiences, and also the reference calls that we've done on them. This is what we believe they're strong at. This is what we believe they're weak at. This is what we believe that they'll need to hire at. This is what we think honestly, a lot of times we don't even, it's so early at the seed stage and the Series A, we don't even know what the actual gross margins of the company will like turn out to become, because we don't know all the different like cost of goods sold that are going to go into it. We have no idea what CAC is going to be. We've done some performance marketing testing. So we just have to make our best guess. And then from our best guess, then we create the different scenarios like to the best of our ability. And then we look back and we say, wow, this either like wildly out, and this happens a lot actually, this wildly outperformed our expectations. It didn't actually follow any of what we thought was going to happen. So we actually made the wrong decision-making framework. The outcome is still okay, but we should probably reevaluate that and see if this outcome that is still okay is sustainable, or it's just we got lucky and this luck is not sustainable, or we've like wildly underperformed what our expectations are, and what do we do at this point? And I think those are, so even though we don't know, we still try our like best guess. And I think any VC that tells you like they absolutely know, either your name's Peter Thiel or you're kind of just like lying a little bit, because like it's really hard. On the valuation side, we try to think about like terminal outcome and exit multiples and like what is a realistic exit multiple. That being said, again, we're investing so early. It's like the seed stage, Series A. We don't really think about it in terms of what is the eventual like exited outcome, but more about, again, the subsequent rounds that need to happen. How do you make sure that the company doesn't take you, because now you're on the same team as the customer, as the company, you and the company don't take unneeded dilution to be able to finance the next few rounds of the company. And then so I think, frankly, a lot of entrepreneurs, maybe not in AI, are kind of coming back to understanding that if they raise that evaluation that is way too high with not enough capital to fund their business because they wanted to manage around a certain dilution, it's going to like kind of bite them in the ass later down the road. And then so actually we've seen a little bit almost like of an overcorrection of entrepreneurs saying, I don't want to raise that much capital. I don't want to raise that crazy valuation. I can get profitable off of like a seed round, or I can get profitable off of a Series A, and we'll just be profitable and we'll control our own destiny, because I definitely don't want to get stuck being a overvalued unicorn that like isn't able to raise the next round and has to add in a ton of like structure or like liquidation preferences later on, and I'm stuck at this valuation and I don't know what to do. Yeah.
I wonder, like, so when you mentioned about like reference call to diligence these companies, like how do you, like, who would you call? Like, would you literally be like DMing their boss on LinkedIn, be like, hey, I saw blah worked for you through time A and B. Like, can we hop on a quick call? I'm thinking about investing in him or her. Or like, what's a vibe here? Like, and like, I mean, I did a lot of like customer calls, like what you did with like, the law firms, but like, I think like to just like directly reach out to someone's boss or like coworker, I think it's a really weird move, because like if they're like BFF with their coworker, like first of all, you don't really know that what's their coworker's like vibe, like, and then like you call them and then diligence, like if like, hey, will you invest in blah blah blah, and then I would just be like,
yeah, of course.
I don't know. If someone like just call me, I'll be like, yeah, of course I'll invest in blah blah blah. Even like, I'm not like not close with blah blah blah, but I will still say the good words, because I don't want the word get around to be like, oh, like blah said bitchy things about me, like, if that makes sense.
You'd be surprised.
Really?
Okay, so this is typically how we do it. Of course, like there's always exceptions. So typically how we do it is when we're diligencing the founder, we tell them like, hey, by the way, please provide some references. Also, just as a heads up, we're going to be reaching out to people in your network that you worked for. And so you might, like, if they're really good friends, the person we call is going to give this person a heads up and say like, hey, David reached out. Like, are you cool if I talk to them? So we're gonna give the founder a heads up, just so it's like, hey, is there anyone that we should definitely not reach out to because of sensitivity or because it's weird or because of whatever? Like, tell us now. And usually that's like a little bit telling actually, because for example, if they say like, definitely don't reach out to my boss for my last job because of this. So we're obviously not going to reach out because we just told us not to, there's sensitivities. But like, we're going to take that into account, right? Like, what happened? Give us the if it is a good reason. It's like, oh, they didn't want me to leave to do a startup and they're really pissed. You can reach out to them, but they're going to be pissed. But yeah, that's probably a good reason. But if it's because you were just like a bad employee and you're giving us like a bad reason, like we'll take that into account. The second piece is to your point, like that everyone says good things. So there's like two responses to that. Not everyone says good things. You'd be surprised actually. So I think like the way I think about it, really kind of like relationships and who says what is like, I think like you can think of like, or I think of relationships as like a triangle. So you think of like, I guess like the founder is like the point here. It's like the founder, and then you have like you, and then you have the person you talk to. So the truth is going to flow in the direction of where the relationship is stronger. So like if somehow like, or if somehow I find someone that I can have that knows the founder, but I have a stronger relationship with, or someone on my team has a stronger relationship with, we'll most often get the truth more than like they want to protect like the founder or say good things about the founder. So that's the first piece. Like not everyone actually says good things. And frankly, we're not always looking for good things because sometimes we're on these reference calls and maybe they were a really junior person. So like, and like their reference call was like so-so. They were like, oh yeah, they were like mediocre as like an associate or an analyst. And you go a layer deeper and you say like, why were they mediocre? It's like, well, they were mediocre because like they didn't want to do the job of an associate. They kept trying to do like this and this, whereas like the job of an associate was like do this, and like they're really bad at doing this. And so that we listened to that, we're like, that actually sounds pretty good. That like they probably should be the CEO of a company, as long as they were like good at some other things, right? And like obviously we're evaluating the team when we're doing diligence. The second piece that you mentioned, which was like how, if they are just saying good things, like what do we look for? So I think you can kind of like read between the lines a little bit. So like oftentimes it'll go something like this. It's like, okay, like how would you rank this person in like your like org? Were they top 5%, top 10%? And they're like, yeah, of course, top 5%. We're like, okay, cool. What were the biggest accomplishments that they did? And then they go through like, this is the project, this is the project. And I was like, okay, cool. What role did they have in this project? They led this and they led this. And I was like, okay, cool. Like, so were they, did people directly reported to them, or like were they more of a leader and like organizing things? And what do they actually do? And like what work product did they directly have their hands on? And so you just like keep asking like why, and like a layer deeper. Sometimes you find out that they've actually, this project could not have succeeded without them. Sometimes you find out that they were just like kind of there and this person is trying to cover for them. Or you ask questions like, who did this person have conflict with and how did they handle that conflict? Like, would you work for this person? Would you invest in this person? Like, why did you let this person go if they were so crucial? Like, what did you do to try to keep them? Like, what incentive package did you give to try to keep them? And if they don't have good answers for those, then it's like, you're kind of just like trying to protect for them. And again, like these are all like singular data points that we don't, not one of these things we use to make a decision. And we try to do as many off-deck references as we can. But frankly, like sometimes team diligence or calls to do team diligence is a very limited thing that you can do, because let's say someone had one job out of college and then they started a company. You're not going to make an investment decision based off of that. I think you're going to try to just spend a lot of time with the founders, understand their motivations, like see if they have a chip on their shoulder, ask about their childhood, see what kind of latent trauma they have, and like that hopefully they've overcome and they've used that to power their ambitions, right? But like, and use other data points to try to do it versus like leaning too heavily on like team references if they have a very limited work experience, or that work experience didn't really give them a good chance to show their entrepreneurial prowess.
For sure. Okay, so I want to be mindful of time. So I have a quick 1 minute fire round for you. What's your favorite book?
The Courage to be Disliked.
Oh wow, that's like a good name.
Yeah.
Who would you invite to your dinner party?
Dead or alive.
It's your party.
That's my party.
Yeah.
Lee Kuan Yew. I'm on like a big like Lee Kuan Yew binge the past few years.
Who made the biggest impact in your career?
Probably my career, like my college buddy, Ryan Shee. He told me to go into business as opposed to some other paths that I was exploring, and he could definitely pushed me pretty hard and like interview prep and whatnot. And I still go to him today for like some sort of like very like more like technical questions.
I mean, what other things were you gonna go into? Is that music or something?
No, I'm flattered that you think it's music. I'm like no musical talent. I wanted to be a diplomat actually. I wanted to be like to travel the world and be a diplomat and like be stationed at different consulates and like solve like geopolitical issues and
Oh
crises
wow.
and yeah. And then I found out that like in the era of like Zoom and digital communications, like you actually don't really need diplomats anymore that much. And then also usually the way to be like a real diplomat, like you know ambassador to like Japan or like Botswana or whatever, you just like have to make a lot of money and you donate to someone's political campaign and then they appoint you.
Oh
So
wow,
that's a lot.
really? That's a way to go.
Yeah, I'm working on that. I'm working on that. So
Where can we find you outside of work?
you can find me usually in Noe Valley is where I live, or you can find me like playing in a not very competitive rec league basketball team on Tuesdays. And those are usually where I spend my time. And then obviously like, you know, try to do like very SF things with my wife.
Amazing. Well, David, thank you so much for coming on the show today. It was such a fun conversation.
Thank you for having me.
Okay, let me quickly end stream.